All right, it's time to cover ISOs, which means it is time to focus. If RSUs are the Pee Wee football team, ISOs are the New England Patriots. We have a lot of jargon, a lot of technicalities to cover, so wield your drug of choice. Mine is a quad shot of espresso and strap in. ISO stands for Incentive Stock Option, and the word option is key. It gives you, the employee, the option to buy company stock at a discounted price in the future after your ISOs have vested. ISOs, though, can be a relatively risky gamble depending on how you play it. There were plenty of stories in 2022 of employees exercising options in a rosier 2021 economy and holding their stock for the undoubtedly bright future of their company, only to see the value of their shares plummet in 2022, and then painfully owe taxes on suspected profits that, poof, vanished. Typically, ISOs are given to top employees of public companies or companies that are about to go public. Once you receive your ISOs, you have to make the call about whether or not you're going to do anything with them within 10 years of receiving them. And the day that you receive them is known as the grant date. Your ISOs will come with a strike price, which is basically the price you are being given the option to pay for your company stock. This strike price is key because it's essentially what determines whether or not this is going to be lucrative for you. If the strike price is lower than the price of the stock on the stock market, you would probably consider exercising your options, or in layperson's terms, buying the stock at the strike price, because you could theoretically turn around and flip those suckers for a profit. But if the stock is worth less on the public stock market than your strike price, you probably would not exercise your options, since you could log into your E-Trade account and pay less on the public market like everyone else. It's possible that 10 years could pass in this fashion and your ISOs would expire totally worthless. It's also possible that between the grant date and the exercise date, when you're all vested in shit, oops, I said we wouldn't have any expletives, but I guess there was one, and you can exercise your option, your strike price is way lower than the current price of the stock, allowing you to buy a bunch of shares at a steep discount. So when companies explode in value and early employees are granted ISOs, this is a really good way to become a millionaire overnight, though this is the winning the lottery equivalent of equity compensation. This is not the norm. For example, let's pretend you're granted 100 ISOs at a strike price of $5. Once they vest and you're able to exercise your option, maybe the market price is $20 per share. So you can exercise your option to purchase 100 shares at your strike price of $5 per share. So a $500 cash outlay by you to purchase shares worth $2,000. 100 shares times $20 a share, right? The math is mathing. You could flip them immediately for a $1,500 profit minus taxes. Now, that example works if you're dealing with this question as an employee of a public company. If your private company that plans to go public at some point in the future has granted you ISOs based on their independently conducted valuation called a 409A, it's a little trickier. If you're facing this dilemma and need to make a decision soon, I would probably reach out to a fee-only hourly CFP or CPA who can help you make sense of your decision, as choosing to exercise pre-IPO incentive stock options has serious implications for financial and tax planning, and it's technically a higher risk, higher reward situation. Now, assuming we're talking about ISOs issued in public companies and examples where you're talking about much larger numbers, you don't technically have to spend your own money to buy the shares. And this is where things breach 3D chess level complicated. So I did the responsible thing and I punted this one to Scott and James to explain.
So when you have an incentive stock option, you're given the option to buy your stock at a predetermined price, but you have to buy it. You have to either come to them with cash, which it could be quite a bit of cash. It's okay, where do I get this cash from? Or you could use your options themselves to buy your options. So in other words, if I have 100 ISOs that vested and I need to come to the table to buy them, well, can I sell a portion of those 100? Can I maybe sell 10 of my ISOs, for example, to free up cash to exercise the remaining 90? The other thing is companies that do have ISOs, not always, but sometimes they also have RSU programs in conjunction with that. And sometimes your RSUs will vest on the same date that you have the option of purchasing your ISOs. So what some people will do is, okay, my RSUs vest, I'm going to sell them right away. That provides cash. I'm going to use that cash to exercise my ISOs. And when you do that, and we'll get into this later, I'm sure, but you don't pay income taxes upon exercising.
How are ISOs taxed? The short answer is it depends. If you did what we just described, you flipped those suckers right away, you'd pay ordinary income tax on your profits. So the profits being the difference between your strike price and the price you sold for on the stock market, known as the fair market value. In order to receive the more favorable tax treatment and have your profits be treated as capital gains, you would have to hold on for another year, and technically 2 years from the grant date. For example, because I know that we're throwing a lot of dates at you, let's say you're granted ISOs on March 1, 2023, and you exercise your option and buy the shares on March 1, 2024, you would have to wait to sell until March 1, 2025 to receive capital gains treatment. So, what's the issue with this? Well, it introduces 12 more months of risk. Because when you exercise your options and you pay the strike price, the fair market value of the stock on the stock market might be higher. So, ta-da, profit. But there's no guarantee it'll still be higher 12 months from now. Think back to if my Meta RSUs had been ISOs and I had held on to them. As a sidebar, so you feel up to speed on the jargon, the profit that I'm referring to is technically called the spread or the bargain element because someone decided that we did not have enough bullshit terms to remember already. The point is, if you want your profit or spread or bargain element to receive favorable tax treatment, you have to hold it for longer before selling. This is, in some ways, no different than regular rules around selling stock. You have to hold for a year if you're going to get long-term capital gains treatment, right? Now, if you're a high roller exercising hundreds of thousands of dollars in income and ISOs, you may be faced with the alternative minimum tax. But I would say that is more of an edge case because it really only applies to people who already have decently high incomes and very high options awards.
You're just buying the shares, but that is subject to what's called alternative minimum tax, or AMT, which is something people need to be mindful of whatever the bargain element is. So the difference between the strike price and the market value of the stock on the day that you purchase it, even though you're not paying taxes at the federal on kind of ordinary income taxes on that, if you hold the stock, it is something that's subject to alternative minimum tax, which trips people up sometimes.
So what happens is with AMT, they basically, you run your tax bill two ways, the traditional way and then this alternative way. And the alternative way with ISOs, especially if there's a big bargain element, so the price between your exercise price and the current fair market value, the moment you start with the ISO exercise, that's what's added in to your tax bill. And then you have to pay taxes on that amount on the AMT side of the things. Now you'll get that back as a credit in the future, but it could potentially take years to get that money back because of the way the tax code works.
Unlike RSUs, ISOs are not taxed when they're granted, vested, or exercised, aka purchased. They're taxed when your shares are sold. For example, let's indulge in a jargon-filled run-on sentence. If you are granted ISOs, and then they vest, and then you exercise them, then 3 years later you sell your shares and pocket the spread between your strike price and the fair market value, you pay long-term capital gains taxes on that profit. Human translation, if your company gives you the option to buy company stock at some point in the future at a specific price, and you do that, then a few years later, when the stock is higher, you sell it to some other schmuck, you pay capital gains taxes on your profit. To summarize, I asked Scott and James to outline the best and worst ISO scenarios so you can get a sense for both ends of the spectrum.
The worst case scenario is you do all of this, you pay the AMT tax bill, or maybe you're waiting to sell the shares to pay the AMT tax bill. And then the shares plummet, and then you go to sell the shares, and you don't even have enough money to cover the tax bill.
Yeah, and we saw that a lot last year. How many companies that, Katie, to your point, were high flying? I had clients that saw this. Scott, I know you had clients that saw this. But if you were in companies, not to pick on these companies, but like a Coinbase or Zoom or Snap or Robinhood or Peloton, I don't know that all those offer ISOs, but all of them had stock prices that fell by 80 to 90% or more. So if you're looking at this and saying, oh, I've got this great ISO package here, I'm going to exercise, which means I buy the shares, I'm subjecting myself to that alternative minimum tax. So I'm going to have a tax liability due because of this, but I'm going to be smart and hold on to these for 12 months so that when I do sell after exercising, I pay taxes at a lower tax bracket. And as Scott mentioned, that could be 14% or so lower than your ordinary income tax bracket. So you do that thinking it's a good tax decision. And if everything goes up, it is a good tax decision. But if things plummet, well, now you're sitting here the following year with a tax bill and you're like, I don't even have that much in my accounting. My shares aren't even worth that much. And it actually not only didn't benefit you, but it ended up costing you money to exercise your ISO. So that's a very real risk. And I think that that's why we will typically don't let the tax tail wag the dog, in the sense of, yes, we want to be smart about taxes, but if doing that is subjecting ourselves to a huge amount of risk, that's what risk actually looks like. And I think that we hadn't experienced that for so long because so many stocks had just gone up and up and up, that 22 was kind of a difficult reminder of how things actually work. I would say the best case scenario, as Scott mentioned, isn't just that the stock goes up, but it's that it goes up more than the market. If your stock's going up, you exercise and your stock increases by 10%, well, that's good. But if the rest of the market went up by 20, you still would have been better by selling, diversifying, and capturing the rest of the market. So best case is holding on to those shares for at least a year after they've been exercised for the best possible tax treatment. And then also best case is, did your stock outperform the market, which is something that's impossible to predict ahead of time because everyone thinks their company is going to outperform the market ahead of time. But the reality is most companies don't.
If you're dealing with ISOs and you've got questions for a professional, Scott and James had a few words of wisdom for who to seek out depending on what you want to know.
I would say if the question is just around what's the tax implications of this, and that's it, a CPA is going to be able to do that, because a CPA will help you model out what is your potential alternative minimum tax liability, what should we do in terms of, do we have a budget for how much we exercise this year to keep things under certain thresholds. So if that's it, yeah, a CPA is probably good to work with once you start dealing with ISOs and other forms of stock compensation, because it can very quickly become overwhelming, and then a mistake becomes very costly. And even if you don't make a mistake, you're always worrying about, did I do that right? Did I miss something? And just kind of have that there. If your bigger concern isn't just, it's not just, okay, how do I get taxed on this? It's how do I best utilize this in the pursuit of the things that I actually want to accomplish? I think one thing that Scott and I, when we talk on our podcast, it's never about the money. It's never about the portfolio. I think commonly we think of, oh, better finances means growing my portfolio, growing my 401k, growing my savings. Well, to what end? It's all about how do we use that for what's actually most important. And so if you want help understanding, one, how do I prioritize? How do I set, we call them goals, values, whatever you want to call them, but how do you set kind of intention for what you want life to look like? Then how do you understand whether it's the tax implications or what you should do from an investment perspective, or how you should coordinate this with cash flow? How does it really all come together to turn some of the success you're having maybe financially into that peace of mind of knowing that you're on track for what actually matters most? That's what a CFP or a financial planner is going to be better suited for, where it's not just super myopic on the taxes, but looking at the big picture to see how to do things.